Welcome to the Stock Market Palantir. Today, we are going to talk about SentinelOne, which is a really interesting high-growth cybersecurity stock that is just stuck. It's in this frustrating price range near its 52-week lows, hovering around, what, $16.23 in late November 2025.
Yeah, and that price action it's shockingly suppressed, especially when you put it up against the rest of the cybersecurity sector, which has been pretty resilient, with really high valuations. So that difference has created this massive tension for investors.
Exactly. And the question we have to resolve is pretty stark. Is this price suppression a temporary sort of structural anomaly driven by technical forces like options hedging and dark pool activity, which would make it a deep value opportunity? Or is this just the market correctly repricing fundamental weaknesses? We're talking heavy dilution, deep unprofitability, a classic value trap.
Exactly.
For my part, I believe the technical forces have created an extraordinary and I think temporary mispricing. It completely ignores what I see as superior underlying technology, and that creates a really asymmetric risk-reward profile. And I'm going to have to hold the opposing view there. While I respect the depth of those technical factors you're talking about, I think they are symptoms, not the root cause. The current suppressed price is a rational reflection of persistent, underlying fundamental flaws. SentinelOne is showing all the hallmarks of a growth stock that the market, which is now demanding profitability, is finally just giving up on. And that defines a very vulnerable value trap.
My core claim is that SentinelOne is fundamentally and structurally mispriced. It's because of these market microstructure forces that are aggressively inhibiting true price discovery. The valuation discount is it's too extreme to be rational when you actually look at the product.
Look at the evidence. Its price-to-sales ratio is around 6 times. That is a huge discount. If you compare this to peers like CrowdStrike, which often sits between 14 and 20 times, or even Palo Alto Networks, we are seeing an irrational 60% haircut on valuation. And this gap, it's unsustainable because the underlying tech is arguably superior. SentinelOne's AI-native architecture, particularly its Purple AI platform, is consistently validated by IT professionals in the field. They cite its efficacy in automated ransomware remediation and its ease of use compared to legacy competitors. This technological strength is being stifled by temporary market mechanisms, specifically the immense gravitational pull from options positioning. We see the max pain point, the level where the most options contracts expire worthless, is aggressively pinning the price right near the $16.50 to $17 strike zones for the December 2025 expiry. That is a technical dampener, not a reflection of the business's long-term health.
I'm sorry, but I just don't buy that the structural mechanics are the primary threat here. Let me tell you why I think that price discount is rational. The persistent price suppression is a logical market response to two key fundamental failings: the inability to achieve basic profitability and the anexa, the constant negative drag of its capital structure. The valuation discount is justified because SentinelOne carries a significant Rule of 40 deficit. For a high-growth company, the rule suggests, the growth rate plus the profit margin should exceed 40%. SentinelOne falls deeply short. We're talking GAAP operating margins that are consistently negative 30 to negative 40%. That scale of unprofitability makes the market extremely nervous, especially now. Look, capital put into S has been dead money for nearly 2 years. The failure of that, what people call the Schadenfreude trade, where S was supposed to capture business after the big CrowdStrike IT outage, that just demonstrated that enterprise stickiness creates a moat that S just can't seem to breach. And then you have the optics of insider selling. The CEO, Tamar Weingarten, selling over 160,000 shares near the 52-week lows. That just reinforces the value trap narrative. Management is maybe unintentionally signaling they don't see the current price as a buying opportunity.
But that brings us directly back to the technical mechanics, because I would argue that this price suppression is so intense, it actually creates the institutional low conviction you're talking about, rather than the other way around. It becomes a technical, self-fulfilling prophecy.
I come at it from a different way. While off-exchange volume is, yes, undeniably high, suggesting massive institutional flow, the resulting market price reflects economic reality. The high off-exchange short volume ratio, which consistently runs between 30 and 50% of daily volume, is interpreted by many institutional desks not as malicious suppression, but as necessary hedging against the risk of a high-beta, non-profitable stock.
Right.
This volume is a clear symptom of low institutional conviction because the stock fundamentally lacks the quality factor, meaning consistent profitability, that has dominated the investment world all through 2025. Institutions are just managing risk in a volatile security. They aren't conspiring to hold the price down.
That's an interesting point, though. I would frame the effect of that differently. While it may not be a deliberate conspiracy, the operational result of that high off-exchange short volume is this tangible, wet blanket sensation over the stock. It prevents organic buying pressure from ever registering on the public order book where real price discovery is supposed to happen.
So you're saying it's effectively suppressed regardless of intent?
Exactly. As high-frequency trading firms and market makers execute this complex flow management, they internalize retail buy orders by short selling in the dark pool. This technically satisfies the order, but it prevents a green print on the public exchange. It kills upward momentum before it even starts. The evidence for this is in the divergence. We have moderate total short interest, only about 5.7%, yet a perpetually high daily short volume. That divergence confirms these forces are controlling the market, keeping it artificially range-bound between $15 and $17, independent of the company's strong growth metrics. So my question to you is, if the technology is so superior, how long can that institutional apathy withstand SentinelOne converting this purple AI advantage into real market share gains?
Well, that conversion you're talking about is a fundamental event, and fundamental gravity is much, much harder to escape than technical gravity. A technical wet blanket lifts when a price breaks out, but that fundamental drag stays put. I appreciate the depth of your analysis on max pain and HFT flow, but let's pivot and address the capital structure, which is arguably a deeper, more destructive drag than any temporary options pinning.
Okay, but before we focus entirely on the drag, it's crucial to just get rid of this retail confusion about a reverse stock split. It's completely unfounded. It stems from conflation with another ticker. We need to focus on the real corporate value. The expanded collaboration with Amazon Web Services, their deepening integration, and the edge from Purple AI create a fundamental backstop. That technological superiority fuels realistic M&A speculation. Cisco, Oracle, maybe even AWS itself. This acquisition talk acts as a strong psychological floor against market capitulation. If the stock trades this low, the corporate value just becomes too attractive.
I'm not convinced by that line of reasoning because while the literal reverse split rumor is false, the dilutive effect of stock-based compensation, or SBC, acts as what I call a shadow split. And this is a critical factor I think a lot of investors overlook. Let's just break down the mechanics. Every quarter, the company issues massive amounts of new stock to compensate employees. This relentless increase in outstanding shares continually dilutes existing ownership. So when we look at headline revenue growth, it might look good, but the vital metric, the revenue per share growth, is significantly dampened because the denominator, the share count, is always increasing. This structural dilution creates a persistent supply wall. As RSUs vest, employees sell those shares, and this provides immediate, consistent selling pressure that just crushes every minor rally. Why should the stock break $18 when management is effectively issuing new equity just to compensate the current workforce?
Every high-growth SaaS security company. However, the value argument means you have to weigh that cost against the potential future revenue acceleration driven by product differentiation. The market pays for future cash flows, not just past-on profitability.
But the market is now entirely intolerant of growth at all costs. The stock price volatility in November was triggered precisely by that kind of skepticism. We saw Barclays lowering its target to $18, citing mixed feedback on new recurring revenue. That shows the market is losing faith in the growth trajectory's ability to offset the profitability gap.
Okay.
To consistent non-GAAP profitability and, crucially, free cash flow generation, the current PS discount is justified. The company's lack of profitability makes it extremely vulnerable to interest rate sensitivity. Growth without a clear path to positive unit economics is now penalized, not rewarded.
I see why you think that, and I agree the market requires a clear profitability timeline now more than ever. However, let me give you a different perspective, one rooted in the recent technical price action. The stock has recently staged a crucial technical rebound from its absolute 52-week low of 1517. That was triggered by heavily oversold conditions, the RSI dipping below 30. That indicates a strong psychological and technical support zone exists, regardless of the fundamental critiques.
A bounce? Sure, but is it sustainable?
Well, more importantly, the bullish thesis lies entirely in the purple AI differentiator. We have to focus on the growth catalyst. If the company can prove that this AI product significantly lowers the barrier to entry for mid-market enterprises, letting less sophisticated security teams use natural language for threat hunting, it dramatically expands their total addressable market. If the upcoming Q3 earnings can show concrete adoption rates and prove purple AI is directly leading to accelerated growth, it will be the catalyst for a fundamental re-rating. That is what finally overcomes the shadow split effect and breaches that stubborn $18 resistance.
That is a massive if that the market is waiting to see substantiated. We need tangible metrics showing purple AI is not just a feature, but a driver of superior economics. If December 4th shows continued heavy reliance on SBC, combined with just maintaining the current growth rate and no clear path to FCF, the fundamental flaws will continue to outweigh any technical bounces. The market is demanding quality growth now, which means growth that requires less dilution.
So my thesis remains that SentinelOne represents profound deep value. While the market structure, the dark pools, the dealer hedging around Max Payne has exerted this extraordinary pressure on the share price, the underlying tech and the valuation discount signal massive potential energy. The December 4th earnings report is the definitive test. Management has to convert technological promise into demonstrable financial execution.
And my conclusion remains that the market is acting with rational prudence. It's valuing the company based on structural realities, specifically the perpetual drag of dilution from SBC and the persistent profitability gap. The high off-exchange volume is less a conspiracy and more a reflection of institutional flow management in a stock where fundamental conviction remains low. Investors have to weigh the potential for a temporary technical bounce against the sustained structural drag that has held this stock back for 2 years.
So SentinelOne sits at a critical inflection point, where the control exerted by market microstructure meets these overwhelming fundamental business pressures.
And the ultimate verdict rests on whether management can finally demonstrate accelerated profitability alongside continued growth and thereby prove that value thesis valid.
Today, we dissected the dichotomy between SentinelOne's suppressed price action due to dark pools and options pinning versus the fundamental concerns of heavy dilution and the persistent profitability gap. Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.